Hi everyone, I just want to share some of the latest market insights, which in this time give you the opportunity to make money from investing, given how much the stock market's fallen and how quickly it's rising back. I'm going to give you some insights from my expertise as a fund manager, as a hedge fund manager, and as a private equity fund manager. I'm going to give you some frank insights, the type you see when I do the newspaper review to 300 million people on the BBC. And just as you will gather from what I'm about to tell you, I absolutely love the markets and they've brought me immense pleasure. So just a quick who I am. Well, I'm the CEO and founder of Profinium, which is a private equity fund and a hedge fund. We have multiple sub-funds. We're a British company. We're not open to private investors, so this is not a plug for the fund because only institutions can invest in us. That's the law. Only sovereign wealth funds and pension funds and the like. Okay, so let's get on with it. Just quick piece of information first. Please don't just blindly buy anything that I talk about in a moment because I don't know your personal circumstances, so this can't be financial advice. And equally, please don't copy these slides and send them elsewhere. People sometimes like to copy my material and send it on. First things first, let's just do some simple maths. We've seen due to COVID in the last 3 months, some stocks drop 50%. Well, let's just remember, if something does drop from 100 down to 50, and if it goes back to 100, well, you're doubling your money. Equally, if something drops from 100 to 33 and then goes from 33 back to 100, you would triple your money. So, what are these stocks which have dropped this much? And are they worth buying? Maybe they dropped because they were rubbish. So what are they? And is there really a possibility of have a tenfold increase in your capital? Can somebody sensibly say that? Let's have a look at that. And some of the data and information that I'm going to rely on and give you comes from a variety of sources, not just my expertise as the author of some of the books you can see over my shoulder, published by the Financial Times, like The Mind of a Trader and Trading Online, but also source of information I get on my desk, such as that from Goldman Sachs and the like as well. So let me give you that information. Well, first of all, look what's about to happen to America as the rising death toll increases. This is America if it was shown by the amount of the economic size of each of those segments. And you can see that what happens in America is very significant. So you can see why the market's fallen off. But the question then is it going to fall some more or could it rise? What strategy will protect us from further falls so we still are in the market and exposed and make use of that opportunity? Equally, if we've seen the worst of the falls and the rallies continue, how do we make sure we're not sitting on the sidelines just waiting to, twiddling our thumbs, waiting for it to bottom when it never does and it just keeps rising, so we're not left behind? How do we avoid that? Put another way, look at some of these cities. Just these cities alone are the size of countries when it comes to economic output in America. So what happens there is really going to impact the rest of us. So what does it mean for us? Well, in the words of Goldman Sachs, most markets, and we saw this before, we've come here and we've now rallied, most markets don't just keep going upwards. What actually happens is you get a fall. Given that there's some possibility of that, do we want to hold cash? No, I don't believe so. Do we want to wait until there is that fall? Well, what if it keeps rising? Because this time it's different. There's a global coordinated effort to push up equities. And so we don't want to be sitting on the sidelines in the expectation there might be a fall if one never comes. Okay, so I do believe we need to be in the market. So we need to have some quality companies. There are only two types of companies: quality companies and higher reward companies. The quality companies want to have, because if the market's rising, we want to be in them. And should the market fall, well, we'll buy some more of those quality companies, because quality companies you'd always want to own. Equally, with some of the higher return ones, let's just go back to that. With some of the higher return ones, if the market rises, well, they'll give us a return anyway. But if it falls, well, they will indeed fall. But we will elongate our holding time frame so that we still get the returns on those higher return companies. So which are some names? How did I find them? How do we make sure we've got a decent strategy? Well, first of all, let's be absolutely clear. And again, I'm relying on research out of Goldman Sachs. You can see that when the US markets represented by the S&P 500 have previously declined, yes, you get some of these rallies we're seeing at the moment. And that just reiterates my point that we do not want to see the recent rallies as something which means we should just plow into any old company, because if we do then get subsequent falls as we have in the past, we want to make sure there's a combination of quality companies and also high return companies we're willing to hold for a long period of time. Got it? Quality companies and high return companies we're willing to hold for a prolonged period of time. We do not want to be trying to bottom guess. We don't want to be trying to work out when the bottom might happen. Instead, the optimal strategy is quality companies, which I'll tell you in a moment, and higher return companies that even if the market falls, we'll hold for a longer period of time, and if the market just rises, well, we're in higher return companies anyway, so we're laughing. See why that's an optimal strategy? Okay. So let's move on to the next slide. You can see here, again, my concern is that if there is going to be a recession, and the average length of a recession since, well, for over the last 100 years is about 13 months, you can see again why we want high performing companies and also quality companies as well. Statistics are not on our side that we're going to avoid a recession and we're coming straight out of market falls. This is something McKinsey has sent to its clients, its biggest companies in the world. And what they've said is, depending on the public health response and the economic response of governments, is whether or not we'll get a quick, sharp reversal. If we've got a very good economic package by governments and a good public health response, in other words, we all stay in our homes, then yes, it'll be closer to a V-shape. But the danger is that in actual fact, it'll drag along a bit. But it'll probably be in one of these quadrants, says McKinsey, the global consultancy. And I think they're right. It's going to be in one of these, and it's probably going to be this one, I suspect. Either way, it reinforces my strategy that we want either quality stocks or high performance stocks. So again, which are these? Well, one way to look at it is we could do an index tracker or an exchange traded fund, put another way, like the Qual, Q-U-A-L is its symbol. And it's composed of quality companies. So that's a simple way of doing it. You can see how since 2016, they've done rather well. And even when they've fallen, they tend to rise back relatively quickly. But you might say, well, Alpesh, that's just an index tracker. I actually want to know more. What I want to know is what's in those. Well, here are some of those that are in there and also the kinds of returns they've generated. So you might say, well, I'll pick some of these. Remember, these are our quality picks. But again, you might say, well, Alpesh, you know what? That's a bit safe. I was playing it a bit safe. I can see how you've drilled down. In fact, now I can see the contribution that some of the companies have made. By the way, Microsoft and Apple, those two companies alone have the same total market capitalization as the entire largest 100 listed British companies. So you can see why if you're looking at quality, we'd look at these. But I want a bit more zip to my portfolio than just buy Microsoft and Apple. I mean, I've done that 10 years ago, 20 years ago. Tell me something new, Alpesh. So let me tell you something new to add a bit more zip. First of all, I have bought an exchange traded fund, ETF, in the S&P 500, which is triple leveraged. In other words, for every dollar the S&P rises, I get $3. Now you can see why I've done that, because in any given year where there's over a 20% return, the S&P 500, well, look at that. Those are all the years. These are the years where it gives me a 10 to 20% return. So let's say I get more than a 20% return in the S&P 500. Triple leverage means I get a 60% return. 60%. You can see why, given that in the significant number of years I'm going to get over a 10 to 20% return, triple leverage means I'm going to get a 30 to 60% return on most years. 30 to 60%. That's the S&P 500 exchange traded fund, triple leveraged. I'll talk more about those kind of things. You see how that sort of minimizes my risk because it's an index tracker of an entire index, but zips my reward because it's triple leveraged. So what are my other strategies? Investing strategy number one, I look at what the super rich are buying. This table shows you the S&P 500, the 500 largest American companies, color-coded by the quantity of ownership by some of the biggest names, such as Berkshire Hathaway, Peter Lynch, who are buying into them. The darker the color, the more the biggest companies have bought into these. And you can see Viacom, Fox, Booking, Berkshire, Amazon, and that one, that's United Healthcare, okay? The darkest of all. So let's look at some of these. That's a starting point. It's not the end point. It's a starting point for these. So how am I going to narrow these down? Well, one of the first things I'm looking at the moment is analysts' price targets. Why am I looking at analyst price targets? Again, I'll show you how to get this software in a second. Analyst price targets. The reason is given COVID, there's very little to go on. We can't go on future earnings, obviously. We have to go on things like what the analysts are telling their wealthiest clients. Now, under normal circumstances, I would not look at analyst price targets. As you can see by this red line, the analyst price target tends to be way off what the share price is, and it often doesn't meet it. But now, given that it's all there is to look at, and also the gap is so big between the two, you can see how this could easily rise up and move from 42 to 78 and give me, even if it doesn't get to the price target but near it, give me a 50% return in a major company like Citigroup, which, as I just said in the previous slide, is one of the big S&P 500 companies which a lot of the biggest funds are putting money into. So you can see why it suddenly becomes more attractive, and that as an approach becomes something which gives me more reward for relatively low risk. Other names which are up there, 134% upside on Capri Holdings. But Alpesh, over what kind of period? I see that the analysts are saying this, but over what time frame? Well, let me ask you this. Let's say that took 12 months. Let's say it took 2 years. If I get 134% return, more than double my money over 2 years, am I happy? Of course I'm happy. That's the way to look at it. Is it a high performer? Yes. Might not be quality. I think it is quality, but might be a high performer. The way to mitigate your risk, elongate your holding time frame. Remember, we're talking buy and hold. Walt Disney, 44.4%. One that I've recommended to my sister who's looking to save money in her pension plan for my nephews and nieces' school fees. So you can imagine I got my neck on the block. Forget 300 million viewers on the BBC with my neck on the block. This is my sister. Okay, so why Disney? Again, 44% to the upside. Not massive, but lower risk, okay? Let's add a bit more zip, 55% to the upside. Uber Technologies, says who? Well, Goldman Sachs, 24 other companies who are saying strong buy after the whole COVID story is over. I don't think people are going to look at public transport. They're going to need more semi-private transport like that. Or Hertz, 172% to the upside. Again, picked by Goldman's recently, analyst forecast. Big, major size company, not going to go under. You can see why there's upside there. Viacom, again, some of the biggest funds, 190% to the upside is the projection. Am I willing to hold that if I have to for 3 years to get to that kind of target or near there? Of course I am. Of course I am. In fact, if I wanted to reduce my risk, once I got a 50% return, I might take my initial investment out and just then purely have profits run. Got it? Simple. That's one way to mitigate your risk and not just be buying and holding blindly forever. Citigroup, already mentioned. Fox, 89% to the upside. Okay, similar kind of analysis. And that United Healthcare one I told you about, well, so many people have already got into it. Might be a bit too late for this one. Only 33% to the upside. Okay, of course, there's a lot more analysis I do when I pick these kinds of things, but don't worry about all of those figures. I'm just giving you the fish at the moment. I can teach you how to fish in a moment. By the way, if you're interested, given where the S&P is, roughly 2,700, this is what some of the biggest banks are saying it will be by year end. Okay, you can see Goldman Sachs, JP Morgan, Morgan Stanley, what some of them are saying. And you know what? Some are saying it's going to be below today's level. Some are saying it's going to be above. Great. Thanks, guys. Again, you can see why I want to be my own fund manager. Pick some of the quality ones and the high performers. Investment strategy number 2. What do big banks tell their clients? Well, we want to know that. 2 things that they're really focused on at the moment. Altman scores. You might never have heard of them. It's a formula that big banks use to work out the amount of working capital companies have. That's important right now during COVID, and retained earnings, the profits that they've kept. How important is that? This formula works out that score. Any score above 3 suggests a very good company. Any score below that, and you're taking more risk. The lower the number, the more the risk you're taking. What's the other factor that they're looking at? Well, this is a presentation slide from Goldman Sachs. Okay, Goldman Sachs Asset Management. Deutsche Bank also use this to tell their wealthiest clients what stocks they like. What it basically does is it measures the cash flow a company is generating based on the amount of capital it's already invested. It just looks at the efficiency of a company to produce cash. Why cash? Why not profits? Profits can be manipulated by accountants. Cash is very difficult to manipulate. And that's why Goldman Sachs and Deutsche Bank use it to tell their wealthiest clients right now what equities they like. And when I'm analyzing equities, I look at their Croki scores, I look at their Altman scores. I have one or two other algorithms as well for picking equities. By the way, how many should you have in your portfolio? On the whole, the benefits of risk reduction by increasing the number of stocks drops after about 12 to 15 stocks. So keep it at about 12 to 15 equities, which are reasonably diversified. Remember, a Shell and a BP is not diversified. They're both in oil. They're pretty much the same thing. So speaking of cash flow, investment strategy 3, very important one. This is one Warren Buffett particularly likes. It's one we like as a private equity fund. We look at cash. How much cash are they generating? And what we look at here, something called a discount cash flow in order to value a company. So this is Alamask Group. Okay, current price 63, fair value based on its discounted cash flow. In other words, all the future cash flows that we expect it to earn, it might earn 110 tomorrow, 110 in a year, 220 in 2 years. Well, we bring all that forward and say, well, what would ownership of that today be worth if in a year I'm going to get 110, 2 years I might get 200. What's that worth to me today? And that's how what you do, a discount cash flow of a share price. And you look for shares which are more than 50% undervalued. I'll throw you a fish. Alamask is one of them right now. Alamask, okay, is one of them right now. So let's just look at some of those earlier ones with a bit more zip instead. This is the ticker symbol for Amazon shares, but 2 times leverage. In other words, Amazon goes up $1, I make $2. Similarly, Brent oil goes up $1, I make $2. Given that it's at $20, and I anticipate, given its long-term average, that at some point in the next 3 years, it'll go up to $60. That's a triple rise. And given I've got 2 times leverage, I would make 6 times my money over a 3-year period. Am I willing to wait 3 years? Might even happen by the end of this year, but let's say it takes 3 years. 6 times return on my money over 3 years. Of course I'm willing to do that. Of course there's risks involved. You should only ever invest, because all investing is risky, with risk capital, money you can afford to lose. That goes without saying. Apple, 2 times leverage, exchange traded product. It's like an index tracker, but for Apple, I own that. T. Rowe Price based on Croki and Altman scores that I mentioned earlier. Legal and General, FTSE 100, 2 times leverage. Yes, because of what's been happening most recently in the markets. Why do I tell you all of this? Because you can be better than overpaid fund managers. You should be fund managers. Why should you be fund managers? Well, I did it. You can do it too. Okay, this is me in the Financial Times in 2004, winning a competition to forecast the markets over a 12-month period. I came top. You can see there, Patel is top FTSE 100 forecaster. Not only did I come top, it gets better than that. Not only did I come top, okay, but look at who came 14th, a certain Mr. Neil Woodford, who narrowly beat a cat, the editor's cat. And you can see this overpaid fund manager then ended up in 2017 apologizing for his poor performance. 13 years later, history caught up with him. Cost a lot of people a lot of money. That's the reason why I say you can be fund managers. I was a private investor, beat people like him, so-called professionals, using the techniques I've just shown you. And that allowed me to set up my own asset management company. It's not open to private investors, sorry, pension funds and sovereign wealth funds only. But the reason I'm telling you this is when I used to write my diary of an internet trader in the Financial Times before I set up my first ever hedge fund, I was a private investor. No silver spoon in my mouth. Then went to this following the techniques that I just said, and I've summarized them for you. If you'd like to learn more about investing, listen, my firm and I, we've created a wonderful piece of software. Well, lots of software we use. We provide access to that. Just go to that URL. It's a 10% off as well for people watching this. You've got the mentoring directly from me through instant messenger, through emails. There's a course on there as well. There's all the software we have, and the course is updated daily. There's a Telegram channel. We update what I'm buying, everything that I buy for my investments personally in my pension and for my longer term holding. It's announced to you before anybody else on that Telegram channel. A Telegram channel is an app which sits on your desktop as part of this package, or on your cell phone. I hope you'll join me and you'll learn to invest, learn to become a fund manager yourself, or you'll just like some of the things and learn from me some of the things that I'm talking about. And I included in all that all the stuff that you've already seen and some of the software that we've used as well that you'll get access to. There's only a one-off fee. There's no ongoing subscription charges, no software subscription charges, no daily charges, weekly or monthly charges. Can't get better than that. alpeshpatel.com/shares. We want to bring fund management or investing to the absolute masses. Okay, so I hope you'll join me on that journey. Thank you very much.